Okay, guys, last article today. We got to talk about CoreLogic because it's already been, 2 months of the whole year. I have not brought any CoreLogic to you. So now here it comes, okay? I give you a break. It's not every month.
Thank you so much.
It's not every month.
I was itching. I don't know about you. I needed some numbers.
It's not going to be
data.
every month. It's not going to be every month. It's going to be every once a quarter, okay, guys? We're going to do a CoreLogic once a quarter. This one is definitely nerdy, but I want to talk about this specifically in the mortgage sense because it's the loan performance insights. This is foreclosures. Foreclosures, there's only 3.1% foreclosure rate, which is 97% of people making their payments on time. And I'm going to draw a direct correlation to our unemployment number, which is 4% currently. So you have foreclosures less than unemployment, which I think is honestly a very good sign.
Yeah, that is a very good sign. Very good.
But is it?
It is because, and here's why. And I'm going to put this chart up on the screen. And what you're seeing up on your screen is the 30 days or more delinquent national. And this is the 3.1% of homes are 30 days or more past due. And as you see in the progression, you get to 30 to 59 days, 60 to 89. It's fewer and fewer and fewer. What's super interesting is you just jump to the 120 days plus.
That's what I circled too.
See how it says 0.7?
Nothing.
And then you have in foreclosure 0.3 or 0.2. This is people getting out of that somehow, very last minute.
Yeah.
So my point I made a couple minutes ago was like, hey, I got something to show you guys on the graph. I was like, wait a minute. They didn't overtly point this out, but look at the dark number there. You see 0.7 to 0.2.
Just kidding. Where's my foreclosure?
That's only a third. So of the people in the 120 days past due, only a third of them are actually going to foreclosure.
Yeah.
So where are all the foreclosures? We said we're coming, and we heard we're coming. Where are all those people now?
Yeah.
Where do you think they are, guys? I have no clue.
After the pandemic, though, we had government assistance where people were getting loan modifications. The government was asking them not to pay payments, or they were getting payments paid by the government. It was like 550 some million homeowners, so I think they're going to start coming now with this new administration. All that stuff, the umbilical cord is just going to be cut. And I think that's when we'll start seeing a lot more of
free market,
of these foreclosures.
So on the 120-day time frame, so what is that, 4 months? So do you think that, like, let's say in 4 months from now, it'll be higher than 0.7 in your estimate?
Yes.
Yeah? More like maybe 0.9 or 1.1.
I won't say exact, but I think it's going to be an uptick for sure.
So possibly some more spillover from this 3.1 kind of cascading into the 30 days, the 60, the 90. Okay.
Yeah.
I think if there's more layoffs and people lose their jobs, I could see that number going up as well.
Yeah.
Okay. Yeah. All right. Now, again, to your point you made earlier, though, well, if you have equity in your house, you could just sell it, thus avoiding foreclosure. So I think tucked inside this number somewhere is some of that inventory where people are selling, which is maybe where some of the inventory is coming, which is odd, though, because if it is that inventory, then why isn't it showing up in the pending home sales report, right? So there's some gap there. There's something still falling out of the net where it's coming through the funnel, and it's something's falling out somewhere. I don't exactly know where it is, but I also wanted to bring up one other quick thing, which is the select states graph, where their overall delinquency rate in December 2024 was significantly higher than the national average, but hadn't changed from the previous year, which is interesting because you see Louisiana, Mississippi, West Virginia, Florida, Alabama, and Georgia all well above the average. But then you look at the next next column over, their annual change had their change like not at all or barely anything at all. Yeah. So they're pretty much par for the course and very consistent despite being higher than the national average. I think that's economics. I think it's got economics written all over it. How about you guys?
Of course.
All right. So one more thing is home prices keep climbing in the U.S. Many homeowners continue to acquire equity, which can be used to help borrowers pay their bills in times of need. How many times have we been talking about this? How many examples do we have? How many people you have calling, emailing, texting you, yo, I'm in trouble. I need to get some money out of my house. I need to consolidate my debt. I need a home line of credit. Like, this is what we've been saying since like the summer of 2024, maybe even the spring of 24.
Yeah.
And hey, CoreLogic is now saying it. So I'm going to take a victory lap. They're confirming what we've been assuming.
Yeah. Well, the confirmation is there with what the actions that we've been performing. For example, I'm doing a cash out right now for $200,000, and $70,000 of that, the clients, they took my advice 8 months ago, and they already got their permit. So they utilized their savings to go get the architect work on one of their properties, which is a garage conversion. And they already got the permits for that. They already got the subcontractors going to go in there and they're going to do the work. It's going to cost them like $70,000. All permits have been paid, and so now they're going to break ground as soon as I give them their money.
Wow.
And then the rental, because they're here around the corner, they're going to rent that 1 bedroom, 1 bath for $2,200. So what's cool about that is their mortgage. I did the math. And once we broke everything down to the client, it seemed like, whoa, it's $200,000. I don't need that much, Will. I only need like a few to pay that. But once we put everything on paper and I gave them that rate, at that time, it was a 7.6, right? Now it's gone down to like a 6.875. Wow. So now they're going to be paying, they were paying $3,600 currently. So their payment, I want to say, went to like 56. But now if you're renting for $2,200,
there's your
covers. Yeah, well, because on the surface, on its face value, someone says $200,000, like, whoa, that's a lot of money, right?
And Andy, I'm sorry, but that's to cover the debt and the ADU. Remember, $70,000 of that $200,000, so they paid off debt already of $130,000.
That's what I'm saying. That's crazy.
You know what I mean? So because of the rental income they're going to receive from that, it offsets.
Well, right, because they're canceling out all that out-of-pocket expense connected to that debt, but also then creating a cash flow stream too. So I'm actually I'm really curious later to see what that net change is per month.
Yeah,
because I understand. I hear you saying the gross change
Yeah.
is more, but their net change is going to be substantial.
Oh, of course.
Yeah,
of course.
And I know there's also people. Oh, you should never do that. That's fine. You don't have to do that. If you're in the comments, you're like, hey, no one should ever do that. That's fine. We're not telling you need to do it. He's saying someone is doing it, and he's telling us why.
Yeah, I know, and it's a different. Everybody has a different appetite. This is how we figured out. Because they're older. So it's like, how do we position them in the best position possible, utilizing their current investment? And this was the best solution. When you put it on paper, it's like, whoa, that makes perfect sense.
Well, how else are they going to pay $130,000 of personal debt off?
Exactly.
No, I mean, unless you have that money or you're generating that money, you're just going to be like dripping to pay it down, which is going to take forever or not at all. So back to your point earlier, like people that have equity can sell their house, they can refinance it, pay it off, or do that and then also do the garage conversion and create an income.
But here's the other thing. A lot of people don't want to make that sacrifice. They don't want to lose that storage space, right? And it's like, realistically, you're just storing a vehicle or Christmas stuff. Like, the whole idea is just get out of that mindset and leverage the garage so that you can utilize income out of that.
And to most people, it does not sound traditional. That's traditional ownership. But again, like we've talked about how the idea of traditional ownership has changed dramatically, even just in the last 5 years. Not just generation by generation, but I think it's that, and also because of what housing has looked like in the last couple of years, it's completely shifting the behavior.
Absolutely.
It goes back to just, leading with your emotions, and it's like emotionally living rather than, practical living and being able to pay your cost of living down, while at the same time being able to put more money back in your pocket. But a lot of people look at it like, well, this is my house where I'm going to live at, not a business that I could run at. It's not, I don't want to do that. It's too much. But at the same time, they're putting themselves in a better situation down the line, but at a sacrifice right now.
Absolutely.
Yeah.
Can't wait to see the after.
Well, no, I have no more graphs for you guys because I don't want to show you the last one because you're just going to make fun of me. So I won't. I'll spare you the last one. But I'm going to. Okay, fine. I'll show it. Here it is. All right. So this is actually the metropolitan area map that shows. Because if you look at the state, the assumption looks, oh man, that state has it really tough. But when you look at the municipality map, it's actually pockets that are driving the result for the state, not the entire state of its own. So it's spread out here. You see how it's kind of speckled, if you will, for lack of a better term. So for those of you who are listening, you have this map of the United States, and it's got each of the states, and then it's got these county boundary lines, and it's speckled with these different colors that are showing the density of foreclosure and delinquencies. And what my point is here is that the entire state is colored one way or another, but it's really by the pockets that are generating it. It's not every county that's having the same problem. It's not every part of the state, and it certainly is not every state at large. So there you go.
Boom, boom, boom.
Make more of that if you will. Otherwise, that's it from Professor X today regarding that.